Okay, and now let's try this again. Recording now. All right, hi everyone. Welcome to the timingresearch.com crowd forecast news for May 15th, 2023. We are recording this at 1 p.m. Eastern time, and this is episode number 386. So today I've arranged for Michael Filighera to join us again, and you should be seeing his screen right now. And the option professor is back to moderate, so I'm going to go ahead and turn it over to him.
Okay, thanks, David, and welcome everybody. We've got a big week ahead of us. Retail sales coming out. Big box retailers are going to tell us if they're making or losing money and how much inventory they have. And then, of course, we got housing sales coming up, which mortgages were up quite sharply. So the death of the house market doesn't seem to have happened just yet. So there's lots of stuff going on, and of course, we got the debt ceiling drama. So there's always something out there, right? Today, Michael Filighera of Logical Signals is here, and he's going to go over a lot of the technical stuff along the lines of Elliott Wave and Fibonacci. And then I'm going to add a few of my own insights and opinions along the way to try to give you a nice full meeting here today where you can come away with some ideas. Okay, Michael, introduce yourself a little bit now, and then we'll get started.
Sure. Good afternoon, good morning or good evening, wherever you are on our globe. My name is Michael Filighera. I am the analyst, proprietor, owner, tradershelpingtraders.com and logicalsignals.com. Within that, what I do is I have a trade room that is connected more with teaching, with coaching. So I offer coaching services, and then though once you're under coaching, then you come into a trade room where we try to actually utilize what we're learning. So it's basically a learning trade room, I'm going to call it. I also produce a daily update on the S&P 500 and the NASDAQ 100. Those would be the futures markets on an Elliott Wave basis. And then I also do once a week, I do a big picture update, and that I do under my Eye of the Storm podcast.
Perfect. And at the end of the broadcast, we'll explain how everybody can get a hold of us if they need to. We're going to start out here, and we're going to talk about the S&P 500, which we can see is pretty much range bound for a while. Let's start out with our Monday morning question, which is always from where we started this morning, which I don't know the exact price, but it's probably in this neighborhood. Where do you think the S&P might end up by the end of the week? And up, down, sideways, and what's your conviction level, Michael, as far as what did we open up at today? Can you see?
We did, and we opened today at 41.35, let's call it.
Which is pretty much where we are right now?
Pretty much, because it says here it opened at 41.34.90, but that could have been yesterday's Globex session, the start of the Globex session. So
but whatever, normally there's an advantage at this time because the market is up or under the starting point. Today, there's no advantage. So what do you think might happen between now and the end of the week? Because with this trading range, Lord knows, right?
Yeah, and that's a good one. Actually, by just connecting to our opening half hour, I'm going to say we opened around 41.26 in the SPX. And
okay,
if I had to make a call, it's quite clear. We're sideways. We're sideways in a range. And the range really has not broken since the beginning of April. So, we can take it back, and yes, we get some great moves, but we're stuck in a range. And every single day, we may go down and test the bottom of the range, but at the same time, and I'll go switch back over to the ES since that's the one we all trade. We get to the bottom of the range, and then we just buy it back up almost to a midpoint. But we seem to continue to hang on to 41.50. So we don't drift too far away from it, and we don't go too far above it. Now, in my opinion, we need to get above it to finish a pattern that's been in progress since the October low. So, but we're not. We're stuck, and we're not moving. And every time we get additional information, it almost feels like you've been talking about, Jim, that the market's continually waiting. I'm waiting. We need more information. We need this. Well, we got this, but we need more. So I'm not sure what's going to tip it in either direction as we wait. But if I had to say how this trades during the week, that we may end up lower, but still within our range, but just maybe back down towards the lower end of the range as we did last Friday.
Yeah, the debt ceiling thing could be an instigator in that if they did come out and get an agreement, which doesn't seem like it's likely right this second, but if it happened, it might take those short-term interest rates back down, and that might give the market a short covering / FOMO rally. So that'll be interesting because according to some people, there is a lot of heavy short interest out there. So obviously people are not positioned for an up move. And then also the VIX being in this, shall we say, languishing neighborhood does not scare big investors. So sideline money could very well come in. And then, of course, that 2-year note, if it were to fall apart, or the 90-day money that's up at 5.5% or better, if that were to fall apart, that might be very good for the NASDAQ and maybe get everyone back on the buy side. Because, in this market, if it's everyone's buying and there's no sellers, the thing just takes off. If there's nobody buying and all sellers, then basically it tanks. So there's really because of the algorithm traders, the volume seems to be very one-sided sometimes. You know what I mean?
And that almost tells us, and I was reading actually that I have felt for a long time, there is a serious absence of macro traders. Those are the hedge funds, the portfolio managers, and all those type of traders, but they trade on the macroeconomic picture. If they feel that interest rates are going to go up, they're going to come and make adjustments to their portfolios to kind of lean in that direction. And so as things change, they do the same thing. Now, the last thing that I saw that the macro traders were doing in mass, so to speak, was they were bringing money back and putting it back into the market, but they were putting it back into the tech titans, as I call them, the tech sector leaders. And so, and then I saw that again happened at the end of last week. But then today we get a little bit, not a lot, but we get a little bit of a twinge of like, okay, they're moving back out again. So again, I just think there's a lot of
I was looking at my account and I saw a lot of the safety trades were losing value today. Things like utilities and dividend stuff, that seemed to be on the outs today a little bit. Whereas it seemed, because again, I use a ratio of growth to value and large cap to small cap. And it's been definitely favoring tech over value since the fourth quarter, and it hasn't turned yet. So as much as people say, hey, this tech thing is going to roll over, there's no evidence of that just yet. And also on the area of large cap, small cap, there's no evidence of the small cap taking over yet either. And if you look at the Russell since last October, it's been a snooze fest. And if you've been in small caps, you've underperformed the large caps in a big way. Right.
But I will say, this is the hourly chart. So let me go out to the daily. So we're just getting the last couple of days. What I can tell you, what I see here in this Russell is a very small triangle pattern. And whether it's now breaking out of that triangle, but it's the Russell's the big winner today, as a matter of fact.
Yeah, well, again, because if they get a deal and rates yields do drop substantially, the Russell will get a bid. And then if in fact the lows are in, we're not going to break under 40.50, we're not going to go back into the 3800s, at least before they wipe out all the shorts. Then the Russell could be one of the leaders on a rally, albeit maybe it'll be short term, but it'll still happen,
Right. But here we go again, and we're starting to now press. There are windows every single day. We have the 1 o'clock to 2 o'clock window. We've got the 2 o'clock to 3 o'clock window. And these are where we get a lot of algorithms that come in and they're doing their business. And whether they're on the buy side or the sell side can change every day. So we've just entered into a window and we can see that they just come in and they come in as buyers. Yeah. And so what's really been underneath the NASDAQ today has been the decline that we're seeing in Apple. They're just kind of like evening out the position, whatever they're doing, but they are kind of hitting Apple. But other ones that they seem to be liking within the NASDAQ are, well, they liked Tesla until about 5 minutes ago. But we're seeing that NVIDIA, now NVIDIA reports next week. So now we're going to have that focus shift a little bit back over to chips. And then we see AMD pick up a little bit of a bid. So
of course,
whether or not that is going to give us a definitive clue really is what's just changing day by day. And as an analyst, kind of making us crazy because we're range bound. We are range bound. And
do you see I had two ranges. I'm using rough math: 42.10 on the upside and 40.50 on the downside. And then I had a smaller range of 41.80 on the upside and 41.10 on the downside. So you really got two ranges that I'm looking at. If you break the first range one way,
you can draw a channeling. That's absolutely correct. There's your 42.10, 42.11, which is actually 42.06. So there's that top side. There's your bottom, just as you said. And then there's the secondary. And so what I can, and even if we just for the exercise, okay, just for the exercise, because what you're going to start to look for is it going to come out and where's it going to break? So we're just going to tie it up here and we're going to see. So is it really forming a larger triangle pattern?
Right. And if it comes in through the bottom, or would this be coming in through the bottom or through the top? In other words, they always say that a triangle will break the opposite way of where it went into the triangle.
Right. I want to just redo this top one to get that top line there. It's going to change it ever so slightly. Let's just say that this is A, this is B, this is C, this is D, and then we have A, B, C for E, right? Where would it resolve? It would shoot up.
Right. Yeah, that's what I was going to do. Because it came in through the bottom, it'll go out through the top.
Yes. Now,
no, and listen, they say positioning is heavily short, if that's in fact true. And that obviously would be favorable to the bulls. We have been definitely unable to keep it under 4,100 for any length of time. That's for the bulls.
We're not even going down and testing that level right now. We keep thinking we're going to get down there, but it doesn't.
No. And then, so you've got a decent amount of short covering that could occur on any kind of news that would be positive. And then, again, some people think going into the Memorial Day holiday, people are happy. And so that might be a seasonality thing that could be helpful.
Yes. And yes. Now, one thing I want to add to the conversation is in our pre-show a little talking that we did is it's important, I think, for traders. I don't care if you're a day trader, you're a swing trader, you're an option trader, you're a little bit longer term trader. A part of the understanding of why we're sitting in this range is because within option volumes, folks, the 0 DTE options, and what that stands for is 0 days to expiration. So they are extremely popular. And they've really now account for over 50% of the daily total options volumes. That's in one product. And I'm just going to kind of show, we're going to go over to because the most popular one is the SPX. So here we have these options. They're called weeklies, but this is now today. These are the 0 DTEs for today. So you can kind of come down and you can start to pin together where the largest positions are. And what that then relates to is where the largest gamma position is. Because now what we're tying together is what they will do in those 0 DTE options. Here we have as the 4130 strike. It likely will start to rotate out possibly to 41.45, because you see where we go, where we're heading. So, but being that it was the 41.40 now, sorry, well, yeah, the 41.40 being the highest, we're at the money. At the money call is trading at $5.
And they want $5 for that? And they want $5
Yeah.
premium for that.
And this expires, folks, this expires in 2 hours. So we see all this activity. And when we add the puts and the calls and you put them together, plus some of the little bit longer dated options, and then all of that goes into and gets spit out by a very skilled firm that puts out the gamma flow. And then when you're looking at the gamma flow and you see those numbers change because of how the volatility is changing, right? So if we realize that volatility equals premium, so what's going to happen as these options get closer to 4 o'clock when they expire? Well, if it's at the money, so right now, even if we're talking intrinsic value, the 41.40s are at the money. What's their value? 30 cents, 25 cents. So you can see how, oh, 39 cents, 44 cents. So it's going to change frequently, but certainly not $5. So if I'm a seller, if I'm dealing in these and I sell this call at $5.40, I'm effectively selling the underlying at 41.45.40. I've got the premium now in my hands.
Right.
And what you do with that premium is going to make you or break you.
Right.
I want to add into that.
And then what are the puts
Jim.
alone? Like say you did a straddle here. What's a straddle go for? The 41.40
straddle right now is still
4 3/4
between $9.50 and $10.
$9.50 and $10. Yeah.
Yeah.
So that means if it stays in a window, if it stayed in a window of 41.30 and 41.50, the guy's gonna have some kind of a loss on that thing.
Right.
On the buy side. On the buy side.
Yes. Agreed.
Yeah. I mean, you know,
loss on the short side too.
I have been following the volume on these things. It's amazing these numbers that I'm looking at: 31,000, 25,000 as far as volume is concerned.
Yeah. Well, let me show you one more that is even gonna make our eyes bulge out a little bit more. The spiders are even, look at these numbers, Jim.
Yeah.
339,000, 239,000, 372,000 put the 411. Now, the relationship is the spiders are 41.32, I guess. I'm not sure exactly what that breakdown is to how I can equate it back to the SPX or the ES. I believe it is going to come back to the SPX. So these are crazy volumes. Granted, it takes more contracts to equal one contract in the SPX within the spiders.
Yeah, it's like, I think it's like about 10, something like that.
But look at this volume. So when we're talking about that zero DTE options are basically in control, it is why you'll hear me say sometimes, what has really changed in my mind, Jim, is that the options, which were the derivatives, have become the underlying, and the futures or the ETF is the derivative.
Yeah, no, there's no question about it. And like we were saying beforehand, as an option guy for all these decades, I think they've just replaced the futures because, in some respects, because of the unlimited risk. If you want to short the market, if you do one of these puts on a long side, there is a limited risk aspect. And so if there's not much time premium in them and you can get a short position with limited risk, it's got to be more attractive than to some people than the other. What I was going to show you is an idea that I had on Apple. Can you put up Apple real quick? I just wanted to explain something that because I've done this a few times on options. We'll look at Apple options, but I'll also explain something that I was focused in on the other day when Apple was near the high. So I was going to look at the chart as well.
Do you want to look at the options?
Yeah, look at the chart. Look at the chart. Look at the chart first. Yeah. So the high on Apple was 174 area, right?
174.50.
So what I was looking at, what I was looking at was something like a 1 week or a 2 week option on Apple up at 175.
Go
A
back
put.
and look. Here's the
Yeah.
1 week that, you know, like if you would have been looking at it
So
last week.
like what's a 175 now? Let's just say
The call is 39.40 and the put is 315 at 330.
315. So basically, and that's a 1 day, or that for the whole week?
This is for the week. These expire on Friday.
Okay, for the week. Okay. So basically, if somebody wanted to have a sell position on Apple, but wanted to have a limited risk situation, and then see if Apple would unfold for you, rather than shorting Apple at say 172 and have it gap up to 182 on you, and you're down $10. Some people might say, give me the 175 put that goes off on Friday. Now, I'm in the money here. I'm not paying just a little tiny bit of premium. And let's see where it closes. And if it closes down at 167 on Friday, maybe I would let that contract, if I'm a trader and I'm suitable and all the rest of the facts, I might let that go to, shall we say, exercise, and have a sell position at 175, and then hold Apple and see if it's going to go down to 165 or 160 or whatever it might go to on a correction. So it's a way, you know, to get into something with a limited risk and a week to see if you're right or not. And if you find out that you're I only like to look at these at turning points. So obviously Apple's coming off almost an all-time high at 174, isn't it?
Right.
Yeah. So, I mean, this would be something I would have looked at on Microsoft at 132, you know, when it was coming off their high. Or 232, what was Microsoft's high? 232, was it?
Let's go over and take a look. I think you were pretty close with what you just said.
Yeah.
Because, you know, last week we got up to 313.
314. Yeah,
So
you would look at a 315. You would look at a 315 put, and maybe you would give it a week or so, and then you would see if there was going to be any reasonable correction. If you thought that was going to happen. You know, some of these markets don't correct, but sometimes they do.
You got a lot more juice. You got a lot more juice here, and the 315
yeah,
put.
But let's switch over to one that did have a good drop, which is Meta. META definitely had a drop as I saw it. This is one where it would have been a reasonably decent outcome, I think.
So we want to go back over and look at the chart first.
Yeah. Okay, it went down pretty good there for a little bit, right? Yeah.
It did. Why they're pumping it today is anybody's guess.
Yeah, but I'm saying, but at least you would have had a trade out of it, you know, without having unlimited risk. If you did a put, say, at 245, and then you went to,
my God,
yeah,
yes.
then you went to see if it would go down, because you're trying to get it into a situation where you're going to try to get as close to 1-for-1 with the price of the underlying as you can. You see what I mean?
Right. And if you were to put this on, say, last week, you're going to get more premium. You got more just because of the time factor. So over the weekend, volatility, AKA premium, they take it out. They take out a chunk of it on Friday because you got 2-day weekend. So if you were to put this position on, as Jim is talking about, and you would have done it last week, ooh, you got a lot more premium.
Yeah.
But even though we're in the money, you're going to see that we've just shifted to almost parity.
Yeah,
very quickly.
The reason these 0-day things and the strategies that I'm kind of talking about, using puts in lieu of shorts, or you could do using calls in lieu of buys, is because of the limited risk aspect when you're buying them. And then market makers love it because, again, all these premiums that are out of the money have to go to zero at expiration.
Right.
So you've got a lively auction out there with a bunch of people who want to speculate with leverage and have limited risk. And you've got the writers out there who believe that time decay is going to be their friend over time.
Oh, yeah.
And so basically you've got and that's why the volumes are so high, because that's a lively debate.
Absolutely.
Yeah, that's a lively debate. Yeah.
And this occurs every single day in the SPX, the ES, the spiders, the Qs, the NDX, the NQ. Some of the bonds now have 0 DTE options. It is getting more and more and more listings.
And
via-
listen, Michael, another thing, a little while back, there was a huge fever for penny stocks. And so this is also that whole crowd that wants to buy into something that can go up or down 50 or 100 or 200% in a day, like a penny stock. You know, those people who want that type of action, they're also gravitating to this now because you can, you know, obviously speculate on some of these options for 100 or 200 or 300 bucks, which is right up the penny stock gambler's alley.
Right. Now, one thing I still do like a lot, I do like the Qs as the, you know, the go-to. I don't trade NQ options, nor do I trade the NDX options, basically because they trade by appointment. But in lieu of that, you can come over here. Again, these are 0 DTE. These expired today. And they trade like, as we say, Jim, May wheat. They are extremely popular.
And the other thing about the Qs, again, if they have a settlement and you get these yields to back off substantially, you know, that's going to make people jump into the Qs. And like I said to the people that I write in the letter, you know, I got a ratio switch to go into tech in the fourth quarter of last year, and I have no signal that that's over. And you can see the Qs are at 326. If they get above 330, you know, they may hit an air pocket on the upside for all we know.
I would have to agree with you on the air pocket theory, very much so. And just to explain what he's talking about, when things start moving to new highs, first of all, we get a bunch of stops right above it, right, where that new high would be created. And then you have algorithms that are going to go up and trigger those stops and push, and then you're just on this upward trajectory. And many times it has nothing to do with any news. It's just on the trajectory because it keeps getting triggered, which forces another hand, forces another hand, forces another hand. So you can go quite a bit in there. One thing I want
these
to
guys,
mention,
you used to trade on the floor as a market maker. You know, these guys are going to press the weak side. That's what algorithms are all about. They press the weak side. So if they see it's going through a certain level and they can see that there is nobody on the other side, and they throw in a very large order to, you know, get filled, the guy on the other side who has no help, he's going to raise the offer as high as he can to get this thing filled, but also have some idea that after the volume drives up, it'll possibly drop back so we can get some money, right?
Well, that would be one theory, but unfortunately, there are times when it doesn't, and you wait, which is why we start to see these pockets, these air pockets, these vacuums. We see them start to happen because there just isn't anybody. We do already notice that there is an absence of sellers. So if you don't have macro guys out there for any reason, they're just not going to come in and trade because they are not getting their information they need to make that decision. One thing I want to add about these options, Jim, that I think is important. You were speaking about Meta, Microsoft, and Apple. Those settle into the underlying. Those settle into stock. Whereas your Qs and all of the index products and also ETF products, they settle into cash. So
cash settlement.
You've got that advantage where it's like you're not hanging out being short the stock. If it settles into cash, and if you were short and you're going to collect, then you collect, your money's yours, and everything's set and done. Which also puts us a more positive spin for investors and for the larger firms. That's why they'll stick to these, because they don't have.
You know, one other thing I just wanted to throw out there, because this is a week of retail sales and big box retailers, et cetera.
Yeah.
You know, I noticed that the debt, the consumer debt, has hit 17 trillion in Q1, which is the highest level ever. And for the first time in 20 years, credit card debt did not go down in Q1, which means normally after everybody spends all their dough on Christmas, they obviously pull it in on the first quarter. And for the first time in 20 years, they didn't do that. So you could have some surprises on retail sales. You could have some surprises out of the big box guys, because you would have to assume, unless they put it all on their dining card, in other words, everyone's out there eating and traveling, unless that's where all the credit went, you could have some surprise on retail sales and big box people. You know, if in fact this credit card data and this consumer debt data has a lot to do with that type of purchasing.
Right.
Or, like you say, you know where the restaurants are like around town, and you know that the travel people are going nuts. So unless that absorbed most of the credit card activity and the consumer debt activity, you could be surprised by the Targets and the Home Depots and the Walmarts, et cetera, when retail sales come out.
I agree. Not to shift our conversation, but sort of to shift our conversation a little bit.
Mm-hmm.
You guys know, and most of you that are here listening may know, that I live in San Francisco. I live in San Francisco, right, California. And I just want to share, because I believe what we're really quickly approaching that suddenly just does not get looked at is what I'm now terming as the 800-pound gorilla in the coal mine. The canary died a long time ago. Now it's been replaced by an 800-pound gorilla. And that is commercial real estate. And here in the city and county of San Francisco, we are in a big heap of hurt. And depending on who you talk to or what article you read, they're going to pin it on a whole bunch of things that actually don't matter. Yes, the quality of downtown. Yes, what's happening on the streets. Yes, we have had a problem with homelessness and drug addiction for 20 years or more. And yes, it is getting worse. But what really is now creeping up and coming home to roost is the fact that prior to the pandemic, we had companies like Metaverse, back then they were still known as Facebook, come into our downtown and put down leases for two entirely in under construction buildings, the entire building. And now said Metaverse has now come back and said, we got to put out subleases on all of this. Well, guess what? They're not going to come and sublease from you, Facebook, aka Metaverse, when we're sitting with a 29.5% vacancy factor. They're not rushing back in. And when they do, it's a big retailer. We just had a homegrown company, right? Williams-Sonoma, big company that's now all over the country. They just closed their Union Square, which is their flagship. I mean, gorgeous flagship store. They closed it. They closed it. They have nothing now. They will have nothing in the city of San Francisco. They have some outside.
Well, listen, if you're over in Sausalito, are you really going to go down to Union Square to buy something for Williams-Sonoma, or are you going to have Amazon bring it over to the house?
You're going to have Amazon bring it over, or you're going to go to Corte Madera, where the last Williams-Sonoma store is. But not just that. So we have that factor. We have Nordstrom closing 2 stores. We have Saks Fifth Avenue leaving. These are Union Square. This was our major high-end retail stores that pulled in a lot of people, visitors, everybody. They would come because they had to go shopping downtown. And it's a ghost town. So our problems are real. But now we're going to add on to that. We also have a real problem with the fact that rents, yes, they're coming down, but people still can't afford to live in San Francisco. So we've got, not only do we have commercial real estate, but we can go to the other side of that, which is still commercial, but they own apartment buildings. They own residential towers that they can't get to rent. Now, a lot of those were built at the height of when construction, get this, to build a 1-bedroom, and I'm not talking about a big 1-bedroom, I'm talking about less than 1,000 square feet, likely less than 900 square feet, $500,000 was the construction cost on average. And now we've got a glut of them.
And also, I saw the Newsom announced that the deficit is $23 billion this year, I think.
Right. Suddenly we've gone from having a whole bunch of extra money to having a deficit. So how quickly can we turn and in a situation that just doesn't seem to be getting any better? Now, add into that what we've already discussed. We have kind of a dysfunctional government at the moment in Washington, D.C. They can't even come to the table anymore because one side's saying it's not worth our time. So they're sending their staff, but yet we want to cut government. And I said, my thing is like, why don't we start with your staff? Why don't we start with with just the glut that we have of people? But that's another conversation.
Clawing back some of the PPP money is not the worst idea in the world. It hasn't been spent. I mean, if you haven't spent the money since 2020,
absolutely. But
more than you should have gotten in the first place. You know what I mean?
Well, I agree, but who's going to give it back now? So that's a whole nother problem. And I think that we, without talking about the actual problems, this is what truly is hanging over the market and preventing bigger traders and bigger companies to actually come in and make a statement about what they want and where we think it's going to go, because there's too many unknown factors still. We've got a banking sector, Jim, that pick a day and we're going to go and try to support the banking sector. And again, I draw your attention to what happened with Silicon Valley Bank and what happened to Silicon Valley Bank the week before they went down. The CEO announced, we're doing great. Look at our earnings, perfect earnings. Another case in point, First Republic did the same thing. A week before their earnings, reported earnings greater than they expected. The stock shoots up. A week later, it's down 99% and being taken over. Now, how many more of those?
How do you think about it? My personal opinion on that bank was that the big guys in there who had their money wanted to get it out, and they couldn't get it out unless they got the federal government in there. It's like AIG. You know, these guys can't get their money out. So what they do is they go to the guy who's the guy who has the money to get them out, and that's always going to be the Feds. So, you know, if they can get the Feds involved, then they can get their money out.
But you're right. Yeah. And then we have that $400 billion worth. Guess where the $400 billion is still sloshing around, folks? It's still sloshing around in the markets.
Right.
It's not sloshing around in some bank. It's sloshing around in the markets. And so when we still have such a large amount of capital moving around, how is the Fed ever going to get their job done? How are they ever going to get a hold of inflation? When our currency, they keep flooding and putting more stimulus into the market. At the same time telling us our goal is we want 2% inflation. So you see, we're getting a lot of mixed signals. We get a lot of things. And so here
their balance sheet went way up during that bailout by about $300 billion. So they didn't make much progress. It was like 8.9. It went down to 8.5 or 6, and now it's right back to 8.8 again.
So again,
running down the balance sheet.
So when we talk about our markets and what we think for the week, I think that we really should also start including, folks, how do you want to trade this? I think Jim puts out some superior option strategies for people that'll help you get through a week and then you're okay. But we shorten our duration. And I've gone from being an option trader that you carried huge positions for months on end to none, to trading day by day by day. And that puts me in the position where it's like, I don't have overnight risk. So I'm not worried about that. That allows me to come in each day. That might not be somebody's cup of tea, but you need to figure out, because again, if you're listening to someone like me or you're listening to Jim, we're telling you opportunities, but these opportunities are making money. Now, whether you can do them.
The point is like I say, the reason people are gravitating to the options is the limited risk aspect, I think. And then it allows them to get leverage and limited risk. And because they're on the one-day deals, the actual the time premium is so small, they can get a fairly close to one-for-one action on some of these things. Not maybe at the, maybe not at the money, but if you go in the money and then that time premium goes away, you can get a little bit of a limited risk deal going here, because that would explain. I mean, why would the volume be so high on options that expire in one day? It's because people want to gamble on like they do on penny stocks, or they deal in day trading, or they deal in anything, but they like to know exactly what they're going to lose they want to know
I
exactly what
agree.
they're going to lose when they do it.
I agree. But as in
Yeah.
terms of just why are zero DTE options being of such huge use, or the volumes are so high, I will also add in, unfortunately, one of the numbers that comes out is the retail. Retail is losing big because they don't understand how to actually trade the zero DTE. So what happens is the larger firms and the larger trading firms, which are using zero DTE, and they may be doing nothing more than just wrapping stuff around their existing position, but it expires today. So they're short, or whatever they are, they can trade and do intraday trades.
Cash flow for them.
Yes. But as I call it, feed the kitty.
Yeah.
You live in Las
But
Vegas, you understand that term.
It's a big boys game. It's a big boys game because if it goes against you and you have to.
Yes, it is.
And
it has nothing to
at the end of the day. That's it.
And it's right. And it's not a setup. And it's not that somebody's trying to, put the squeeze on anybody. It's just being used the way that they're set up for these large traders. And it's just the way it is. So my thought process goes to, how do we then, I love you helping me, Jim, draw this triangle. That's a pretty good one, but it is a triangle, but weird. But it may be what's actually happening here.
Well, like I said, if you start seeing prints on the S&P 4160, 4170, 4180, I wouldn't stand in front of them.
No, that would mean the triangle's over. So you're right. But you see what happens here? See what it did? It went up. Now it's coming back down. Let's see if they get it all the way down to here. And maybe that'll be into the close. And then we're all set for this launch party tomorrow. Yeah. Right? If indeed this little triangle is complete. Yeah. Boy,
turn around Tuesday and turn around Thursday, can some kind of happen.
You never
I'm looking at the RSI,
right?
Though. The RSI is kind of, doesn't look that great. So, it's under 50.
But I'd want to see that RSI all the way down at the bottom, showing me that it was oversold, and then let this thing trigger and launch like a rocket.
Because like I say, right now, it's like everything else. It's inconclusive.
Can we talk about gold?
Yeah, let's go over a few things real quick so we don't run out of time. We're going to do gold, we're going to do dollar, and we're going to do the bonds. So let's see what's going on with gold.
Okay. Gold is presenting daily opportunities as well. A little bit confusing, but let me show you how I've got this all counted out. I've got this as like, this was the bottom of a fourth wave. So on Elliott basis, we're in a fifth wave that'll consist in and of itself of 5 waves on this letter or this color. So I'm counting a minor, so I've got to count 5 waves of minute, of which I've got 1 and 2 down. Now we're into that third. What does that do? It has 5 waves in and of itself, but it also subdivides. So I've got another couple of subdivisions here. I got the 1, I'm looking for the 2. It may have come in today. Now, if that is the case, boy, you don't want to get into the way what comes next, because you've got a 3 of a 3 of a 3. And what does that suggest? I mean, Jim, you and I have been talking about this. We've been talking about that this thing's going to zip above $2,100.
Yeah, well, that's the air pocket above 2050 to 2100. That's the air pocket, and if it gets above there, it's probably for a reason. And if it's a reason,
it's going to be for a
big
reason
in there.
Yeah, it's got to be, and I can work out my numbers, but this quickly I can't, because I got to go back and gather them again. But I know I have resistance at some points, like at 2135, 2150, 2167, et cetera, all the way up. But we're talking about a market that has the potential, seriously, folks, has the potential to go to $2,200 to $2,300 an ounce. Now, what is happening behind the scenes here is that we have central banks are serious buyers. They are collecting, not necessarily the United States, because we're reportedly to already have huge reserves of gold. So it is a lot of like China, Russia, India, some of the other countries within the Eastern Europe are in there, and they're also, along with the ECB, et cetera, et cetera. So there's a lot of central bank buying, and trust me, they're not coming in saying, well, let's buy it up to this point. They're coming in and saying, let's accumulate $5 billion worth, or however much, whatever number they're going to come in with. And that's what they do. So we've got a
Yeah, this is
lot
another one
of-
that's kind of range bound, though. I mean, you got a good 2050, 2060 resistance, and you got about a 1950 support. And again, once it resolves that range, you'll have a little bit of a better idea which way it's going to break. So
I agree,
you know,
but again, the point being that all of these downward moves, strong as they are, if you're looking at it on an intraday chart, you know,
no,
if
they
I,
haven't, they haven't been able to get it down.
if I
They
get
haven't been able to
here,
get it down. Yeah.
these are big moves. This
Yeah.
was a great move, and it turned right off and produced a fabulous sell. I mean, if you're a day trader, you sold it and rode this thing down. Now you're riding it back.
Yeah.
So it continues.
And
to
last
just
time we
be
had a debt ceiling problem in 2011, gold did have about a 10 or 12% pop. So, you know, if things get hairy, and this thing gets above 2050, you know, I wouldn't stand in front of it either.
No, but we already know that they spiked it up to where was that one? We got up to
20. It has a triple top at around 2075.
well,
And
this
the
time
thing
we
that
got
I
to
didn't like about
2085.
it is the RSI in 2020 was like about 80 when it went there. The last two times it went to 2075, the RSI has only gotten to about 60. I don't know if that's a divergence or not, but I don't like it.
Well,
And if it is a divergence, it's telling you it's running out of volume up there. And if it's running out of volume up there, then you got to watch the other side. That's why I'm saying if you can start closing above the 2050, 2070 or whatever, and get that RSI above 60, then you can have that acceleration phase. Because you know, a lot of people think that the RSI, if it gets through 60, is when you accelerate to the upside, and the RSI jumps to 75. You know what I'm saying?
Yeah, I do.
So there's a lot of reasons to keep your eye on the RSI, trying to make sure it gets above 60 and very much get above 2070. Because if it does that, I don't think missing out on 30 or 40 bucks of price is going to bother you, because the gap up is going to be probably pretty darn strong.
Right. So this was
You know,
our
it's
last.
always nice to have a crowd behind you. Momentum. You want to have it. You know what I mean?
I do. Let me just look at silver, because I think as you and I have been meeting here, we've also been discussing that silver seems to be a little bit of a laggard. Well, then between our meetings,
Well, I really am disappointed on silver at $26, because it definitely failed at $26. So at this point in time with silver, I would probably like to see a close above 26, and then it might be able to make a run at some of the higher prices. But right now, it has showed me that 26 is a problem.
I agree. Now, let me put this in for you. Here are my fibs. Here we have wave one of three. This is wave one of three. Beautiful, caught up. Now we're in a 2 of 3. What are the potential? It literally, Jim, can drop back to 24, or excuse me, 23 to 22 and a half, and still turn and absolutely. So what is the mindset here? The mindset is, okay, it failed. It's going to go back down. Where's its comfort zone? Well, lately, 23, 22, that's the comfort zone. Below 24. Right now, 24 is holding. So I'm a little bit pleased with that. I like the pattern. The pattern itself.
No, your RSI is in a zone there that looks oversold a bit.
Correct. Correct. So here we sit. I think we might have one little dip back below, get below 23,887. And then we're going to start to rally. And I think that silver will just absolutely clock everybody, just like I expect gold to do the same. Now, lastly, because we're both watching our clock, we want to talk about this dollar index. This dollar index, folks. Jim, what you said in that little when we were just having it, you made me laugh, because it's spot on, but it's just continuing to tell us the dollar, like everything else that we really watch, really has no clue. No. And so we're all sitting in a pool of confusion, waiting for this thing to come through now, one way or the other. We need more information. We need a deal with the Fed. We need a deal from our government. We need et cetera, or we have no idea where we're going to take this dollar. Yeah. If interest rates are really going to shoot higher, well, of course, then I want to see 106. If it's going to really
and also
not,
that 100 number, I mean, when it was at 100, the positioning of the planet was short the dollar. So obviously it's also going up because people that were pounding the 100 level are giving up.
Right. We got some short covering going on.
Mhm.
I agree.
Mhm.
I agree with that. And it can really hurt because you're in the Forex market and, you can really get hurt being short
Yeah.
anything. But it just on an Elliott basis, it really hasn't changed. Now, though, I've got an A, a very complete B, right? And it's all going to, turn into one big flat. So while, yeah, it has the potential to get to 106, I think it starts getting toppy right underneath it. And then it's a perfect A, B, C flat. Now, this is a 4-hour chart. So let me bring it down to the hourly chart, and then we're going to open up that. This is the hourly chart. So here we got off of that, those lows down by that par. And then this is just really ugly. But I can count it as some 5-wave action. But again, we get a pullback. And if I had to put my numbers in, I'm going to be looking for support. Come on. Right here. I'm going to just take it there. Now, this is just very broad. You can refine all this. This would be a minimum, and we're right there. Then we have the 50 period moving average, the hourly, sitting at 102.319. But on all honesty, if I'm taking it from here, A, B, C, that's not pretty. Or this is this is a 4, this is a 5 that completes a down pattern. And what all of this then is, and I'll tell you what I also do, folks, sometimes I go down to the line chart, gets rid of the fluff. And you can see the move a little bit cleaner. But this is massive confusion. Short covering, but massive confusion here. But coming off, if it can hold above 102, and that includes a move down to 101.899, that's still pretty close. Then I think that we have over this midterm here of getting ourselves above 102.75, above 103, above 104, and get it completed here. Now, what could possibly create that type of a move? That we get a sudden downdraft, and I mean sudden downdraft and very quick downdraft in the bonds, in the treasury market. And what's going to happen is going to
okay. Let's switch over to that 2-year note, because 2-year note is really the one that everybody watches because it's pretty much linked to what the Fed's up to.
I agree.
Although it's way underneath the Fed funds rate now, so I mean that's not going to last. One of them's got to change their tune. Well,
this is a very interesting chart because, like unlike the other, like the 30-year bond, the 10-year note, and even the 5-year note, the 2-year note has come down and completed off of their all-time high and the all-time low in the rate. They completed in March. The rest of them are still working off of an October low. But in March of this year, the 2-year note completed the first level, that first leg down. So we're already involved in a bounce. And then on an intermediate degree, that's going to be an A wave. Now we're working on trying to get this B wave complete. I think we can get down to 102.265 to 102.148. I think that holds, at least above 102 holds, and then we get the C wave in, and then the 2-year note rallies in price, yield drops back down. Then off of that level, so we get an ABC and we put a B. So I'm looking out. I'm looking out at least mid towards third, fourth quarter, where we might see some serious damage done to interest rates.
Yeah,
not to the
which
upside.
would correspond to maybe hitting some type of recession out there.
Amen. Absolutely.
Yeah,
absolutely.
because
So
at
I
some point the
think
lag
it's-
effects might start happening. But,
I agree, and I think what also presents
this consumer debt is not indicating recession. I mean, these people are borrowing and spending.
But yes, I agree. There's still a lot of money in the system, and it's out there. And some of it is just because they don't have any choice. They have to have ends meet, And therefore they're
Yep.
using credit cards, or they're using loans, et cetera, because this is just the way things are right now. I think it's a very, very bad setup. I think we are going to run into some serious problems, but I think in between all of that, I think we have one strong, serious swoosh type of a fall. And I think that's equity markets and the bond markets.
Yeah.
Then what is going to result out of that is that within our equity markets, we will be reaching a strong support level. And in terms of Elliott, we will be completing a primary degree C wave. So what goes underneath that is a cycle degree A wave. What comes next? A cycle degree counter trend rally. But it's going to be bigger than the one that we're just witnessing off of the October lows. And it's going to be more pronounced, and it's going to be more defined. And that one being a cycle degree, right? So the cycle degree A started on January the 2nd, 2022. Well, if it takes a year and a half or more, a year and 3/4 to get down to that low, then consider that it's going to take a year to get up to that next high. And there's a lot of good trading that's going to happen both directions. If you're basically a long trader, have patience. Have patience, have patience. Fight
Right.
your FOMO as strong as you can, because the opportunities to buy and hold are coming. It's, in my opinion, folks, it's just not ready yet.
Yeah,
So,
definitely. Hey, Michael, we're near the top of the hour. Let's tell people how they can get a hold of you.
great. Best way to get a hold of me, folks, is send me an email. Michael at MJF1 Partners, and that's the number one. So MJF, the number one partners.com. I always answer my emails. I answer questions, and I'm more than happy. Again, what I have on tap to offer, my primary tool right now that I'm offering out is coaching. And I enjoy teaching. And again, I have a program where I'm using my trade room with coaching. So people that are in the trade room are coaching clients, and we're all there to learn. So it's more of a teaching, not where just come on in and watch me trade. Although I do like to trade. So, but we're trying to teach. And then again, you also can check in with me on Traders Helping Traders on YouTube. I have 2 channels. Always use, somebody hacked our name. We own it, but somebody hacked it. So if you're coming in and you're searching Traders Helping Traders, search for that plus my name, Michael Filighera. Then you will get access to my daily updates and my podcasts.
Sounds great. As far as Option Professor is concerned, you go over to the website, OPTION, Professor, PROFESSOR.com. And put your information in there, and I'll explain how we have a one-on-one online session where I take our indicators and look at your markets. And the indicators I use are none of the ones that many other people use. So it's based on price, time, momentum, and also divergence. So it's some pretty interesting stuff. I've been doing this for decades, so obviously I know a lot about the market. And so, again, we don't have annual fees, monthly fees, or any of that nonsense. And so it's real fair. It's a smart way of trying to get more information. And like I say, we share with you information that we're doing as well as what you're doing. We look at a lot of value there. So go to optionprofessor.com, put your information in. I'll check back with you and explain how it works, and I think you'll like it. Okay, so we're done here for today, Michael. Thanks a lot. I think we went over a lot of great markets, a lot of great stuff, and I'm going to turn it back over to David.
All right, thanks guys. Another great discussion between Michael Filighera and the Option Professor. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube or on Substack or on your favorite podcast app.